Hi everyone, Jay Pace from Providence Property Group here to give you the October market update. So let's jump right in. Australian housing values rose 1.5% in October. That's a similar result to August and September, however, taking the monthly change out another decimal point. And that shows the market's continuing to slowly lose some momentum since moving through the peak monthly rate of growth that we saw back in March at 2.8%. Now, why are there signs that this market is slowing down? Well, slowing growth conditions are a factor of worsening house affordability, and rising supply levels definitely are something that's going to change that market. Then we also include less stimulus that's being pushed through. Remember, the stimulus package that was put through during the coronavirus was 3 times larger than what we saw during the GFC. So with that being taken away, that's definitely going to affect that market. Now, according to CoreLogic, housing prices are continuing to outpace wages by a ratio of 12-1, and this is one of the reasons why we're seeing first home buyers exit this race. They can't keep up. So new listings have surged by about 47% since the recent low in September, and housing focused stimulus such as home builder, stamp duty concessions, they've now all expired. So combining these factors with the subtle tightening of credit assessments set for November 1st, which has just happened, and I'll talk about that a little bit later, it's highly likely that the housing market is going to continue to gradually lose a bit of steam. All right. Now, I want to make this perfectly clear. This does not mean that you should hold off from buying a property. Let me explain. Prices are not slowing down because people don't want to buy property. They're slowing down because they just can't afford it. All right? You will not save money if you wait to buy later. The market's not going to reverse and go backwards. That correction that you and your mates and your friends at the barbecue have been waiting for, it's not happening. All right, the data is not there to support it. And if you don't believe me, go and watch our video from May last year when we said the exact same thing, and the market's done 27%. Now, although the monthly pace of growth is easing, the annual trend has definitely continued to be at a rise, and nationally home values are up about 21.6% over the year to October. Now, for those people who are looking for more excuses not to buy property, I just want to share some quick data and research with you. New research undertaken by Canstar shows that if a person in Sydney bought a house in Sydney for the median price of $1.12671 million, that was back in March, with a 20% deposit, so $222,534, they would have seen the value of their property rise by about 16.3%, or by a massive $181,635 by September this year. So that same person, if they didn't buy property and they just left it in cash and they used that 20% to put it into a 6-month term deposit at the highest interest rate at the time, which was a really exciting 0.99%. They would have earned $2,203, which means that if they did the house, they would have made an additional $179,162 for 6 months. Alternatively, if the same person invested that money in the stock market during that time at a growth rate of the 10.02% that we saw for those 6 months, they would have made $22,000, which again, they would have missed out on $159,067. So property for the win, people. Now, this is something I talked about last week that I got a lot of questions about, so I thought I'd go into it a bit deeper. Unit markets have generally continued to record a lower rate of growth relative to housing. Okay, so the trends are definitely most evident in the annual results that we're seeing, and in the largest capitals, Sydney house values are up a stunning 30.4% compared to only a 13.6% rise in unit values. While in Melbourne, house values rose 19.5% over the year compared with only a 9.2% gain in unit values. As the demand for detached housing pushes prices to new highs, the rental yields are going to start to drop to new lows. And we're already seeing that. Sydney has the lowest rental yields in Australia at the moment, around 2.2%. So we believe that we may be actually seeing the beginnings of a pivot for investors to realign their focus onto units. And I'll give you some numbers soon, which will make you probably think, well, that's a no-brainer. Of course that's going to happen. We prefer to buy properties with good land content. However, and this is a discussion I have with people every single day, there are certain kinds of units that are definitely worth considering. So those are units that are unique, small blocks, period architecture. The rule that we follow is that owning land content is generally superior unless it's in an inferior location. Location. This is why a property in Sydney in Pyrmont is going to be worth more as a unit than a house in some of the inner west suburbs. All right, location, people. Next, the gap between median houses and unit values, that trend has continued to change here, and we've seen that through September with a typical capital city house value sitting at about 34.4% higher than unit value. So we extend on recent analysis that compares unit values and houses in the capital city areas. This table that you can see in front of you here, this shows the LGAs that have the biggest difference between houses and unit values. And we could see the biggest challenge for apartment owners looking to upgrade to houses in similar areas. So if you're a unit owner and you want to upgrade, you know, there's going to be some challenges ahead here, and I'll show you why. The trend is most startling in Mossman Park in Perth. Shout out to all of our clients in Western Australia. The median unit value would account for 21.4% of the standard house value. So in other words, the full value of a unit in that LGA would be a little more than the standard house deposit of 20%. Okay? So similarly, low ratios could be seen across Strathfield here in Sydney, where I'm based, where unit values account for 23% of house values. So a 23% deposit on a house in Strathfield actually buys you a unit outright. All right? Similar in Mossman, 24% deposit for a house in Mossman is what it's going to cost you to buy a unit. All right? LGAs with higher levels of unit stock as a proportion of total housing stock generally, you know, had a lower relative to housing ratios there. This is particularly evident in the Sydney market. So like Strathfield, 64% of housing market stock are units. Woollahra, 61%. Are units, as well as Melbourne markets of Port Phillip, 74.3%, and Stonington, 65.5%. So high concentration of unit supplies have likely put downwards pressure on growth in unit values. It's diluting price, basically. Now, the stock advertised at the moment is currently 26.2% below the 5-year national Australian homes average. And that's really important there. So there's less stock to sell, but there's still more people buying. If we look at how long a property's taking to sell, well, it's currently at around the 28-day period. Now that's down from 47 days the same period last year. So they're flying off the shelf. And we're just not restacking them fast enough. It's one of the main reasons why we're seeing suboptimal product selling for premium prices. Now, we get a lot of questions regarding interest rates. So we're not brokers, but I can tell you a little bit about it. The Reserve Bank of Australia held interest rates at 0.1% through October. Again, no surprise there for us, but there's a lot of chatter around interest rates rising. So the big news at the moment is about increasing rates. Now, APRA recently instructed lenders to assess borrowers' ability to meet loan repayments at an interest rate of at least 3% above the rate that the bank's currently offering. Now, is this something to worry about? Not really. When you realize that banks were previously using a 2.5% buffer and now APRA said you should be using 3%, so they're in fact increasing the requirement by 20%. And APRA estimates that a household that was able to borrow, let's say, $500,000 before, can now borrow $475,000. That's the change. So why such a small change when Australians, and mostly those who don't own property, have been screaming at the rooftops for the authorities to slow down the market? It's perhaps this is a lesson learned from relative the relative shock that we saw during the 2017 changes, when APRA came in after the Royal Commission and told the banks you can only lend 30% of your book as interest only for investments. And what this did is it slowed down the amount of investment purchases that were going on. And that actually brought the market down about 10%. I'm going to move my head here so you can see a little bit more. But basically, we saw that have a significant effect on the market, and we had about a 10% drop across the major capitals. We're of the mind that APRA is going to tread lightly, because they don't want to see that happen again, especially when there's so much heat in the market at the moment. What everyone should be keeping an eye on is how APRA is going to handle potential changes with its debt to income ratios. Now, that's a statistic that's expressing a borrower's pre-tax income divided by their total debt levels. And this could have far more significant effects on borrowing. But we've not yet heard plans about that change, but we're definitely keeping our eye out for it. Listen, as professional buyers agents, we help clients locate, assess, and negotiate property. We've been doing it for nearly 2 decades now, so stop procrastinating. Make sure you contact us. Let us assist you with achieving your goal to purchase property sooner. I want to thank you for your time.